Good afternoon. This is Latoya Paul, and we're here keeping it simple. That's the name of our channel. Keeping it simple, Forex, keeping it simple. There are so many ways to trade, as we all know. But today I'm going to talk about some simple things that I think will kind of help to make Forex less complicated. By this point in your journey, you should have some basic understanding of the terms and all the things that make Forex what it is. Today I want to talk about making sure that you're trading in the right direction. But even in having the right direction, you have to know how far to go with that direction. If I could connect it to anything that we all can relate to, I would connect it to like taking a trip, whether it's traveling to a store or traveling to a far place. There's direction that you must follow, right? I've been thinking about something, and I don't know if I'm the only one that ever thought about it, but we always look at the top-down analysis, but we never look at the bottom-up analysis of direction. Okay, trend changes start on the smaller time frames, and they eventually show up on the bigger time frames with bigger moves, but they start on the smaller time frames. So what I mean is, for me, the way that I trade, I have moving averages, but I use them for direction and not for indicators or indication as to what to do. I use the moving averages for direction, and I use market structure for entry and exit. That simple as that. I also use the TDI to help with the more intricate details, but overall, I use moving averages for direction, and I use the market structure for entry and exit. So as of today, I was, just to kind of give you guys some things that I look at that are consistent. When the moving averages cross, two things that you can look at. First, we're going to just talk about the obvious. We have a green and a red moving average. I'm not going to disclose the numbers because the numbers don't matter. The moving averages, you just have to make sure one is faster than the other. Which means the bigger the moving average, the slower it moves. The slower the moving average, the faster, the lower the number, forgive me. The bigger the number, the slower it moves. The smaller the number, the faster it moves. So with that, it creates a direction, okay? So when the moving averages are going down from left to right, is going down, that indicates that we should be looking for sell trades. You don't go away. Just go away. If the moving averages are going up, as far as not just the direction, but you want to see change in color like this. Let's go. The moving averages are coming together. This won't qualify for this. In order for us to even have a reason to trade in a direction, we want to see the moving averages cross with the, for example, if you're looking to sell, you want to look first for the direction. Are we heading in a downward direction? How do I know? Well, I'll know if the faster moving average, which is the smaller one of the two, is under the bigger moving average, which is the larger. So you want to see it cross in that direction. Okay. Once you see the cross in that direction, then you look for entries at market structure levels. All right. So if the moving averages are pointing down, okay, you should be looking for sales. Once you have the direction in mind, you should be looking for entries at higher lows. Forgive me, at lower highs. And you want those lower highs to be in tangent with previous lower lows. So for example, moving average across here, so I'm looking, it's going down, but I want to get my entry where the lower high was at a previous lower low, which is the same. So you can just look at it. So it'll be an entry here, It'll be the entry here. Real simple. Then you do have days where it ranges, but overall, that's the game. That's the whole thing. Moving average cross, and then you're looking for entries where lower lows have become lower highs. If you can't see it on the 15-minute, you can definitely see it on the 5-minute. So let me just show you this. All right, so we had a cross here. Cross happened. The faster went under the slower. When I say faster, I mean the smaller number went over the slower, which is the bigger number. The more days, moving average is combined of numbers or data over a period of days. So the more days that are being calculated, the slower it moves. The less days that are being calculated, the faster it moves. So I have a cross here, and I want to get in where I see a lower low turned into either a lower low turned to a lower high, or a higher low turned into a lower high. Either way it go, because the trend changed right here. This is where it started. Okay, this is where I talked about the bottom up analysis, because a lot of times you will see where everything is going up on the top down, but your entry is not valid. It's not valid at all. So it's not valid at all. So you would get in, you see moving average crosses, it's going in the direction, and you'll buy because you see the moving average cross, but you didn't look at the bottom up analysis to get the entry. Okay. So we go back to where I was at. So the moving average cross, so we got lower highs turned into lower lows, turned into lower highs. No, higher lows turned into lower highs. So this would have been the entry, and that trade was good all day. And then if you wanted to build on your account, you just continue to look for situations where lower lows turn into lower highs. If you don't see it, it's not there. Period. When as far as things like this, what I'm looking for is when I see when things are trending, I'm looking for I'm looking for bearish convergence. Convergence is when you have straight across on the price action off a low, and then at those same points on the TDI, if I was to put my vertical lines at my points of interest, just drop one there and then drop one here, right? I want to see from left to right, I want to see convergence. So from here, and I have to grab from the bottom, because if you look at price action, I have my trend line under the bottom of the low, and then I go up to the top because I have my trend line over the top of this candle, and it continues down. That's all I'm looking for. And then it does it again. Now this is on the M5. All you're looking for once you have a trend, you're looking for bearish convergence. You're looking to see, if I draw this line straight across, do I have any points where if I was to put the points of interest with the vertical line to make sure that my numbers are lining, my trend lines are lining up from left to right, do I have bearish convergence? Are the moving now, the trend lines coming close together? And they are. So that's another way that I have, based on what I've been seeing, to kind of get me even more out of my day. All right, now this is the cool thing, right? Now you see how price broke this low, price broke this lower high, and if you go straight across, now this is something that you have to learn. This is something that I added to my you have to build on what you know. You can't get comfortable. Now, if I was to go to the 1 minute time frame, you will see how the moving averages crossed again. They cross right here, which is a trend change. So that situation with the N5 is valid. So if I did this and I wanted to see, now when the trend changes, that same point, it'll go from bearish convergence to bullish divergence. And what that means is it's still straight across, right? But between these 2 points, you want to see from this high to this low, you want to see from left to right, the trend lines push away from each other. And the ultimate goal will be something like this. right? Now that's what I'm in a trade right like that right now. So let's see if it pans out. I always gotta have a stop loss in play, but that's the way I trade. I mean, I keep it simple. I don't make it complicated. The only thing that if anything could be complicated, it would be what I just discussed. But that's just something that you have to train your eyes to see. But ultimately, it's still market structure. All right. Uh, yeah. So we'll see what happens with this. Um, Let me clean up this chart here. That's really all there is, guys. When you see the moving averages, okay, I'm just telling you what it is. It's 100 and the 50. It don't matter. It could be 40 and 80. It can be 30 and a 70. It don't matter. As long as one is smaller than the other. I wouldn't suggest going lower than the 20 because the moving averages are when you get beneath 20, a 20-day moving average is so fast that it's like basically hugging the candle. So you really don't a true um a true situation. And it just for me, it's easier to see it because you don't want your moving average to be inside of the move. You want them to be on the outskirts of the moves. You don't want to have your moving averages so involved, so small and so tight that you're getting candles on both sides of the moving average. These like things like this will happen, but you don't want to have the moving averages so tight that you got candles on both sides of the moving average on a 15-minute chart. That's too small of a moving average. But to each his own. All I'm saying is keep it simple. When you can't see what's going on like this, you stay out of it until the market opens up and gives you direction. Gives you direction. Once you get the direction, then you look for entries. You shouldn't be looking for M's and you shouldn't be looking for M's in an uptrend. You should be looking for W's, second leg of the entry. You shouldn't be looking for W's in the downtrend. You shouldn't be looking for W's in the downtrend because that's how you get stopped out. Like for example, this was a low, this is a low. So you can, oh, this is W, or even right here, it's a W, and it blows through. Don't let the M's and W's fool you. The M's and W's have to be used on the appropriate side of the trend. W's are for an uptrend, M's are for a downtrend. Even at the high and low of the day, if that even I don't care about the high and low of the day. I want to know where am I at within the trend because you can have a high of the day during between Asian and London and get down here and think it's a W, and you may get a little bit of play, but you ultimately gonna get stopped out because it's why it's a downtrend. It's a downtrend. Okay. That's all you're looking for. You're looking for direction. You moving averages are for a direction. I call them directional moving averages because they only are good for direction. Most people who trade a moving average strategy, moving average crossover strategy, they trade it wrong because they're using the moving averages wrong. Moving averages are not an indicator. They're just to give you some direction. All right. North, south, east, west is a compass. That's all it's for. Once you know which direction to go, depending on where you're going, you go that way. Period. If the moving averages are showing you an uptrend, you should not be selling. I don't care about shark fins out of the top of the Bollinger Bands. I'm looking for shark fins out of the bottom, and I want those shark fins out of the bottom to coincide with a previous high that ultimately gives me a bullish divergence. Even if it doesn't come across and come all the way back, if I go from point to point, from here to here, I want to see divergence. I gotta go to the top, I gotta go to the bottom. I want from left to right, I want the moving averages to go away from each other. That's all I care about. I don't care about none of this. I want to see some out of the bottom, but I want to see some out of the bottom to where it gives me divergence. And it's coming back to a previous market structure point. Not it may not touch it, but it's close enough. Okay, even with this stuff right here, if I was to go across this, right? That's good, but this is better. Why is this better? Because it was above. I need to see above and beneath. in order for me to know, but even before I draw it, that it's divergence. Even though on price action side, it looks like a range. On the TDI side, it's showing you momentum. I want to see in an uptrend, the momentum builds from the top down and ultimately to push up. In a downtrend, the momentum builds the opposite. Okay, so that's why it diverts. It goes out. So think about it. If it goes down, it's because it got to go back up. And I'll show you what I mean after I draw these 2 points. So this is up. This is down. That's divergence. Now, in a downtrend, it goes the other way. All right, let me just show you what I mean. We got these 2 points, and most people won't even see this like this, but this is what happens when you have to know what you're looking at, even if you don't have uh clean setups. You gotta know what you're looking at. All right, so I got this. It come close? It came close, but it was all I needed to see is close. I need to see a bottom and a top. Why? Because on a downtrend, momentum goes from the bottom to the top because it has to continue down. This is called convergence. Why is it convergence? Because from left to right, these trend lines come closer together. All right, and then it goes down. That's all I need to see. That's all I need to see. Everything else is rinse, wash, and repeat. I don't care if it's a 15-minute on a bigger time frame. Same thing. It doesn't matter. But that's all for today. I'm not going to be repetitious. We're keeping it simple. The moving averages are for direction, market structure for your entries. You don't just enter because you see the direction. You enter after you see the direction, you know what trade you should be taking. That's all. Everything else is rinse, wash, and repeat. All right, guys. Have a great day.